Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings. Today we're diving into Tectonic Therapeutics' latest report, and let me tell you, it's got more plot twists than your average reality TV show. Think promising science, big money moves, and the ever-present question, will it all pay off? This filing is basically a follow-up on their previous registration, including updated information from their annual report. No new securities are being registered, so this is more about keeping things current than announcing something new. It's like that friend who always sends a checking in text. What's being registered here is the potential resale of almost 3 million shares of their common stock by some stockholders. It doesn't mean they will sell, just that they can. A key message here, trust only what's in the report, not what anyone says about it, because that's how you get tricked. They are using words like anticipate, believe, and expect. This is the company talking about its hopes and plans, but also warning that things might not go as planned. Take it with a grain of salt, but it's important to see where they want to go. Tectonic is betting big on its GOD platform, which is designed to create new biologic medicines targeting GPCRs. Basically, they're trying to unlock a new way to treat diseases by going after a specific type of protein receptor. Let's talk about their drug pipeline. They have TX45, which is in phase 1 trials for pulmonary hypertension. And then TX2100 is aimed at treating hereditary hemorrhagic telangiectasia, currently in preclinical development with the goal of IND submission. Here's where the money comes in. The company did a private placement where they sold shares to investors, raising a cool $185 million. This cash is key to funding their ongoing clinical trials and research. It also, importantly, led to this report to register shares for resale. The report points out the risks which is required, and it is something to pay attention to. The first risk they state is that they have limited operating history and have incurred net losses since 2019. This makes sense as they continue to pursue clinical trials and research and development. They also point out that they'll need substantial additional funding, so don't be surprised if they need to raise more money down the line, potentially diluting existing shareholders. The report also makes it clear that clinical trials are notoriously difficult and can have uncertain outcomes. Any setbacks in developing their lead drug candidates could significantly harm their business. The report warns that even if approved for the market, if their drugs happen to cause undesirable side effects, they may end up having to take the product off the market, change the way the product is administered, or face limitations on how the product is promoted. Let's jump to the actual financials and see if we can figure out Tectonic's trajectory and where they are going to take this ship. Since 2019, they invested most of their resources in staffing, developing their technology, building their IP, business planning, and raising capital. So now the real work begins. The company reported a net loss of $58 million for 2024, compared to $42.80 million in 2023. That's a pretty significant increase. The increased loss reflects more activity in the R&D, which is what a biotech investor wants to see. Remember that $185 million they raised? We can see it in the report because the numbers moved up. The 2024, they had $141.24, they had $41.21 towards that runway, depends on how fast they burn through it. Future progress for the company hinges a lot on how long things take. Clinical trials are critical, and if something is delayed, it adds risk and the need for more funding. Their research and development expenses went up from about $37 million to $41 million. That's a big jump, suggesting they're serious about pushing their drugs through trials. Biotech is all about R&D, so these numbers reflect increased activities. However, general and administrative expenses practically doubled, rising from $7.7 million to $16.7 million. This is likely due to costs of operating as a public company, costs related to the reverse recapitalization, increased legal fees, and other administrative costs as expected. Lastly, other income net showed a dramatic decrease from $1.8 million to practically zero. This is connected to how they account for certain financial instruments, which are complex but less important than core business stuff. So Tectonic is a high-risk, high-reward play. They are depending on their tech to give them an advantage. The long-term success depends on trials and data which are never guaranteed. Thanks for watching. If you like this analysis, hit that like button, drop a comment, and subscribe to Corporate Decoder for more deep dives into the world of business filings.